Hi there, welcome. It's Evelyn Olivares here again. Welcome back to your business math in 3 minutes. Fantastic to have you back here again today. Today we're going to be looking at, in this video, we're looking at what are ratios. Ratios rock. You know, whenever you're in business, it's a good idea to keep abreast of what's going on in your business and how your business is performing, how your investments are performing. And one of the best ways to do that, of course, is using some ratios. So let's have a little look at, first of all, before we go there, for those of you who are in my class, in my small business finance classes, the text you will need, there's there on the screen, which is the established the real estate trust accounting, and that's from HERA. So please purchase that or borrow it from the library, no problem at all. You'll also need access to realfocus.com.au, and there's some learning tools, a section for learning tools where you can download all your learner's guides and some great valuable resources for you and videos like this one. So that's where you need what you need to prepare yourself for. Anyway, let's move on to this one here is actually the learner's guide from the realfocus.com.au. You're going to want to need that one as well. That's a great resource for you there as well. So please go ahead and do that. What are ratios? Ratios they show the relative sizes of two or more different values, and they can be shown in different ways. What does it mean? For example, you can use a colon to separate the values. For example, let's say that in your family there are 3 girls and 1 boy. So the boy is 1:3 ratio. There's only 1 boy and to 3 girls. So another way we can look at that is say, well, the girls are 75% of the group, and 25%, of course, is the boy. Yeah. So there are many different ways that we can look at that, and so let's look now at a family of puppies. In this family of puppies, there is 1 black one and 3 brown. So a quarter of the group was born black, and the other 3 quarters were born brown. The black one happens to be a boy as well, and the other 3 are girls. So there are different ways of showing the ratio. So we've got 1:3. We can use quarters, or we can use percentages, and we can use all different kinds of way of showing the different ratios. In business, in the family of business, we have 4 ratios. The 4 ratios are profitability ratios, liquidity ratios, activity ratios, and equity ratios. So the profitability ratios are their ratios expressed in percentage. Yeah, there are ratios that are let's see, they show you. Let's move on to the next slide and let me have a look at it. The profitability ratios are net profit and gross profit. Now, they show you what each sale or the turnover is in the business. The gross profit ratio is only applicable to business with cost of goods, for example. If you were in the business of selling lollipops, then you would either produce or buy the stock, yeah, and that stock is then purchased, and then it's actually sold for a profit. But the purchase of that stock is what we call cost of goods. Now, in real estate, we are classified as a service industry, and therefore gross profit ratio isn't really applicable. We're a service industry, and usually service industries are those that are labor intensive. So although we might refer to our properties for sale, for example, as stock, the stock listed for sale is not something we produce or buy, yeah, to sell on. We're offering a service to our homeowner, and that's what we call the service industry. So that's what the profitability ratios are. Let's look at the profitability ratios. So look at the figures at the bottom first. So we have the sales for the period, the cost of goods sold, to give an example, the gross profit. Then we have expenses, which are reduced from gross profit, which gives us a net profit. So looking at the ratios above, you've got net profit ratio is a net profit divided by sales. And so you'll see there that net profit is 90,000 divided by 140,000, which is the sales. And then you multiply that answer by 100, which gives you 64.29, just as an example. The gross profit ratio is also calculated over sales. So we've got 110,000 for gross profit. And again, the sales is 140,000. Yeah. So that's how the calculation. That's the calculation for you for profitability ratios there in one slide. Let's look now then at liquidity ratios. Liquidity ratios, they're the current ratios. The current ratio indicates the short-term resources, for example, that are able to meet your bills. You know, you have to pay your bills. So it's cash. You're working on cash that's readily available to you, and the formula is for current assets over current liabilities. So yeah, and let's look at the ratios here now. So we have at the bottom there of the screen, we've got current assets and current liabilities. We've got accounts receivable, 70,000, inventory or stock, 20,000, and petty cash in the drawer of 400, which totals 90,400. The current liabilities is our overdraft, our accounts payable, and short-term loan, and all of that. The summation of that is 63,000. So looking at the current ratios, current assets over current liabilities. So we've got 90,400 for current assets divided by current liabilities, which is 63,000. And that's expressed there, as you can see, 1.44 to 1. Now the liquid ratios, it's a little bit more, a little more true, if you like. It's the current assets less closing inventory or stock, and current liabilities less the bank draft. Yeah, look, I know that the inventory is considered as the current asset, and the bank overdraft is a current liability. However, it could be argued that to completely sell all your stock immediately or overnight, and the practicality of the bank requiring you to pay your overdraft immediately is really not a common practice in the business environment. Therefore, the liquid ratio formula removes these two items because they're really not cash in hand right now, are they? So that's why it's removed. So it's a much more true, if you like, a much more true reflection of what you have currently at hand, the cash you have at hand right now. So that's the liquidity ratios. The activity ratios then is the next one. The activity ratios, these are ratios that monitor the activity or lack of in your business. The debtors turnover ratio is the average accounts receivable over your daily credit sales. And the inventory turnover is cost of goods sold over the average inventory. Let's look at those a little deeper. So if we look at what's on the screen right now, the bottom of the screen first, accounts receivable at the beginning of the financial year last year, 2013, was 58,000, and accounts payable at the close of business this year, 2014, 30th of June, was 74,000. The net credit sales then are 840,000. The cost of goods sold is 600,000. And inventory or stock at the 1st of July 13 is 85,000, and the inventory or stock at the close of financial year 30th of June 2014 is 98,000. Now, if you look at the debtors turnover ratio, that monitors the ability of your business to collect money owed from your creditors. Your creditors are people who owe you money, yeah? This ratio indicates that you might have a good collection policy in place. Let's say if your terms and conditions of sale that you will collect the money, the maximum time allowed, it might be, for example, pay within 7 days or 14 days or 30 days of the invoice date, yeah? So what that means is the lower the ratio, the lower the number of days that your staff take to collect this money owed to you. So it's really about just go back, sorry. It's really about, let's look at that, the debtors turnover ratio. We have there, you can see that the average accounts receivable. So what you need to do there is take into consideration the opening balance of accounts receivable at 1st of July, which of course you can see there is 58,000. And we need also to look at the accounts that should be receivables at 30th June, which is 74,000. And then we divide those by 2 because we need an average, yeah? So we add the 2 together, then we divide it by 2 to give us the average, which is 66,000 in this case. Then we look at the average daily credit sales, which is 840,000. Now, that 840,000 is over the 12-month period as well, and we need to divide that by 365. Yeah, so we've got $2,301.3. So the 66,000 divided by the 2,301.3 gives us a rounded up figure of 29 days. So you're actually collecting the money owed to you on average is 29 days. Yeah, so that's not very good. If your payment terms and conditions are 7 days, that's really 22 days out of sync with what your terms and conditions are. Yeah, so your staff or your staff are not collecting your funds very efficiently. Although we don't use inventory turnover in real estate, let's have a look at it anyway, just so that you understand what it's about. We have the cost of goods sold. In this case, it's 600,000, and the average inventory. Yeah. So again, we need to add the inventory at the 1st of July 13, and that at 30th of June 14, and then take an average of that. Yeah, which is what I've done there on the right side of the screen. So we have that calculation equates to 6.56 times a year. And dividing that by 365 by 6.56 means that 56 days, we've rounded it up. So the inventory, remember that this is the number of days a business takes to sell the stock. Now this is important because if you're in the lollipop business, and in lollipop business, as in all consumables, food at least, then they have a use-by date, don't they? So it's really important to know how slowly or quickly you are actually selling your stock. So having stock on hand that's out of date is not a good thing to have in your business. Therefore, the lower the number of days indicates the quicker the business is turning over their stock. So on average, you're taking 56 days to sell your stock, yeah, on hand, which is again depending on what kind of business you're in. If it's fresh food business, of course, obviously it's not very good. If your consumables are, will stay fresh for 12 months, well then it's probably isn't so bad. So I hope that makes sense to you, although you won't be using that in real estate, just so that you have a bit of an idea about it. The equity ratios then, they measure the proprietor's funding for the business, or the owner's equity. I like to call it owner's equity. Proprietorship and owner's equity is the same thing, guys. So the higher the proportion of assets that are financed by the owner, or the owner of the business, the stronger and more stable the business appears on the financial report. If the business is structured as a sole trader, for example, or a partnership, then there'll be 2 ratios which are important for the owners to know about. And those 2 are the propriety ratio, which calculates the percentage of business assets funded by the owner, and the return on proprietor's funds, which calculates the rate of return of the owner's funds that are invested in the business. So you can see the formulas there. Let's take a look then at the next slide, which shows us some actual figures. Total assets at the bottom of your screen there is 1.64 million. Proprietorship at 1st of July 13 is 680,000. Proprietorship on the 30th of June 14 is 500,000, and the net profit then for the year is 280,000. What does it mean? Let's take a look. The closing proprietorship over the total assets for our owners ratio, or the proprietary ratio, we're looking at 500,000 for the closing, divided by the total assets, which is 1.6. You then need to multiply that answer by 100, which gives you 30.49 Okay, so that's what the owner has in the business. The return on proprietors' funds, then the net profit, which is 280,000, divided by the opening proprietorship, yeah, which is 680,000, is 41.18%. So as a business owner, you really need to compare the rate of return against other variable interest investments. So if 41%, return on your interest is pretty good an investment. But if it was down, maybe 10 or 5%, well, then it really isn't a good business perhaps to begin. So you want to look at where you're investing your money, and if it's worthwhile for you. Maybe you're looking over the long term as well. But anyway, they are the ratios you need to know about for this particular section in your training. So again, you're welcome to go to the website, download the information there, the videos and the manuals, and of course buy that textbook as well. So thanks so much again for hanging out with me here with ratios. Maths can be fun, so staying inspired. I look forward to seeing you in class and back here again on your videos. So have a great day. See you soon.